Well, howdy there folks, and welcome into today's video. So you know, sometimes on this channel here, Financial Education 3, we do a little reaction to other YouTube videos. Sometimes it's in regards to a stock they're selling, buying, things like that. Every once in a while we'll do a reaction here and put some YouTubers on. And today we're doing this one. His name is Stephan, and yeah, he has potential. I think he has potential in the YouTube space. I think he can, maybe do something here. But in all seriousness, Graham here has a video says why I sold my stocks. So we're going to go ahead and watch this video. And together I'm going to give my perspective and my opinion on this and see if, I don't know if he sold all of his stocks, why he is selling his stocks. Does he feel like there's a big stock market crash coming? Maybe he feels like that. Maybe he needs the money for something else. I don't know. We're going to find out in this video together. Hope you guys enjoy this as always, and make sure you subscribe to the channel. It's absolutely free to do so. We're on the road to 100,000 subscribers. Hit the notification bell if you want to be notified every time I drop a video. So let's see this and let's pick apart Graham's video here. Alrighty, guys.
I've been investing a large portion of my income into the stock market this year, and I've been really fortunate that most of them have done well. But I also realize that there is a time and a place to take some of those profits off the table, and that is why I'm going to be selling. I know this completely goes against my general rule of thumb that time in the market beats timing the market, and I've always been the type of investor who only buys something with the intention of keeping it forever. But in this case, circumstances have changed, and it's worth explaining so that you can better understand my logic in terms of how and why it makes sense, not only for myself, but maybe for you too. All I ask is that you go into this video with an open mind, and if I make a convincing argument by the end of the video, just do me a favor and sell that like button to the YouTube algorithm by making it turn blue. And I'm being serious. I think you'll agree with my reasoning for selling if you hear this out, and I nearly promise you'll look at your own portfolio differently by the end of the video. So thank you guys so much. And also big thank you to Wealth for sponsoring this video, but more on that later. Now, first of all, I want to get this out of the way, but I'm not a perfect investor by any means, and I made some rather large mistakes this year that I would rather just forget about. And don't worry, I know everyone wants to know what those mistakes are, so I'll go over.
Yeah, let's get into it, Graham. We're waiting, man.
Shortly. But in terms of what happened, as I mentioned before on the channel, throughout the last 2 years, I've done my best to funnel as much money as I could into the stock market as a way to further begin diversifying outside of real estate. See, prior to then, I had almost my entire net worth tied up in 6 rental properties in Los Angeles. Every little bit of spare cash would immediately get reinvested to buy more real estate. And even though I contributed to a Roth IRA to buy index funds, my portfolio did well. But if something were to happen to the Los Angeles real estate markets, I would be done. So beginning in 2020, after being publicly reamed by Kevin O'Leary for not properly diversifying, I made the choice to focus on buying more stocks and index funds because not only was that a lot easier than trying to find and manage another rental property, but it gave me the peace of mind knowing that I would always have something to at least fall back on.
But there's always a catch with all things in life. Whenever you get into something, you're like, oh, it's going to be less time, or, I don't really have to try that hard, or it's going to be easy. That's the catch always, okay? No matter what you want to do in life, if you want to do anything, it takes work, okay? Sometimes you can get lucky and just, happen to buy a house and it just goes up in price, or you just happen to buy a stock and it goes up, or crypto or whatever, right? But as with most things in life, if you want long-term success, it's all about putting in the work.
So glad that I made that decision. During that time, I built now a $7 million portfolio containing several dozen individual stocks that were hit especially hard during the pandemic, along with index funds encompassing the total stock market, international stocks, and S&P 500. I've thoroughly believed in the strategy that you can't time the market, so it's better to invest immediately and wait than it is to wait for the next stock market crash and risk the market going up another 20% while Jerome Powell keeps the money printer cranking. And so far, that strategy's been right. Many of those individual stocks are now up 100 to 200%. I continued adding on to several positions that I believe in. Many are more valuable than I ever expected them to be, and I've intended to continue doing more of the same over the next few years. However, like I said, even though I made a great return and several investments did insanely well, some of them up several $100,000, not everything is a winner, and my biggest losers are worth discussing, because that's partly why I'm getting out. First, we have ARKG. As most of us are aware, Cathie Wood was the pinnacle of 2020. Everything she touched turned into gold. Her words had the power to move markets. And for the most part, she was unstoppable with hit after hit. So I decided to invest $30,000 into her Genomic Revolution ETF with the expectation that the entire industry would continue growing in the near future. But it didn't, and it mutated into a loss of 39%.
Wait. So now the genomics industry isn't going just because that fund went down? That's not how this works, Graham. No. This isn't how this works, man. Like, come on. It's not how this works. It's not how any of this works, okay? Just because a stock goes down or a fund goes down does not mean that the fundamentals in whatever that is broken or it's not growing. There's a million companies out there that are growing substantially and have their stock prices go down. That could be because they were overvalued to begin with when you started buying in. It could also be because of, short-term worries about this or about that outside of valuation, right? Maybe the growth rates aren't as strong, right? Sometimes, let's say a stock was expected to grow 30% and they're only growing 20%, right? Still like massive growth. It's just not as, much of growth as expected. So it's not like just because something goes down, it's like that industry's ruined or something like that. It's not the way this works.
And trust me, this is just the very beginning because it gets a lot worse. Second, we have C3 AI. Going into it, I felt like artificial intelligence had a lot of potential. And overall, I felt like this company would be a promising option for anyone looking to get into the space, both from an investment standpoint and for businesses who want to automate their services. But the moment I began buying it, it started to tank. Unfortunately,
So he was buying when the whole retail crowd was getting in the market, December of 2020, January 2021, February 2021, it sounds like.
Perfect example of trying to catch a falling knife because I bought the dip and then it dipped more. And then I bought that dip and it dipped even more. And now I'm down 62% or $30,000, making the stock more like see $30,000 go down the drain. The third, we got Canopy Growth Corporation. This is a company that I originally bought in May of 2020, back when it was $17 share. And I continued to dollar cost average in a small portion of my portfolio as it continued going up in price. Long term, I felt like the entire industry would continue growing, but Canopy Growth did the exact opposite. In fact, now we should just probably call them Canopy Decline. And in the process, I'm down another 14 grand. Now, fourth, we got Corsair Game.
So as you see with most of these stocks, he's not really buying the dip. So he was buying these stocks as it was going up. For instance, the Canopy, right? He's buying that as it's going up, and now it's going down and down and down. And I wonder, with the C3 AI, this Canopy, does he actually know like what's going on with the fundamentals of the company? And I feel like Graham a lot of times can be the quote unquote prototypical retail investor where they don't really know what they're doing. They don't really know how to value a stock. They don't really know what's going on with the company. They're buying, right? And especially in a hype cycle, let me buy this stock. It's going up a ton. It could be something big. And if you don't really know what's going on, no matter what, you can go down in a position, right? But it's another thing if you don't really know the fundamentals of the company. I wonder how much he knows about revenue growth. I don't think he's listening to conference calls. Obviously, he's not. He would admit that as well. So that's kind of an issue, you know what I mean? And that's what happens to a lot of folks in the stock market. They're not really researching any of this. They're just buying, right? And I feel like, Graham and a lot of folks do that as well as with cryptos, right? They don't really understand, how a lot of these cryptos work. They don't even understand Bitcoin and why Bitcoin should be valued at certain things. It's just kind of like buying because it's like, I think it's going to go up in the future. Well, it can work. And that's kind of the problem with you coming from the real estate industry. And generally speaking, in the real estate industry, that is the way it works, right? It's kind of like you buy a house in almost any market, you expect it to go up over time. That's how it's always been in the United States for the last 100 years, right? You buy any sort of real estate property, you pretty much expect it to go up over time. Stocks and cryptocurrencies, especially if you're buying individual ones, it doesn't really work like that.
Now, obviously, throughout the pandemic, gaming hardware was an instant hit, and I expected them to continue that momentum, at least to a small degree, but they didn't. But that was a mistake we learned in hindsight, and now it's game over while I'm down about $20,000 or 31%. Fifth, we got...
But they did. The numbers, if you look at Corsair's numbers over this year, they've been strong, like very, very strong. So it's not like the fundamentals in Corsair is broken or anything like that. Big funds there's a huge, the Eagle Tree Fund, they own a massive amount of shares they can dump at any moment, right? You got obviously tax loss harvesting going on in Corsair. And also it's a company that's looking to find its long-term shareholder base, which is obviously funds and those sorts of things. So it's not, once again, this goes back to, it's not the fundamentals of the company is broken. It's more like the stock price is broken in the short term.
Talk about Peloton. Now, I know many people see this as an overpriced, overhyped fitness company that was only in demand during the peak of the shutdown. And hey, you know what? Maybe they might be right. But until the end of last year, Peloton was actually a really well-performing stock. Until class action lawsuits and dwindling demand brought them back down to $42 a share. And today it seems like not even their fitness equipment could get the company back in shape. So currently I'm down about $18,000. And six, here's the one I'm least proud of, and I'm very embarrassed to admit this one, but it's...
Yeah, Peloton, obviously that's one I try to warn people about. Peloton, like that's just one of those that was literally just a hype stock in a hype cycle. And it's like when the world opens back up, like people are going to go to gyms again. I think a lot of folks didn't expect that. And it's like, what do you expect here? You can't sell this, crazy, overpriced exercise equipment. Also, if you understand the industry that the fitness industry has been for the last ever since the fitness industry started, these companies go through these very, very, bullish cycles. So that's like a 3-5 year cycle that a fitness company all of a sudden becomes a big thing. You see it on TV everywhere. And then 5 years later, they're like fighting for their lives, essentially. So Peloton, they might not be fighting for their life because they built a, such a cash position, things like that. But, we've never seen it where one of these fitness companies really becomes a beast company. Peloton is trying to be the first company to do that in the fitness space. It is really, really tough, okay? Incredibly tough in that industry. It always has been and it still is to this day.
Robinhood. Now here's the thing, as I'm sure you've seen on my channel, I have been an avid critic of Robinhood for several years. But at the end of the day, despite their controversies, there's still the brokerage that so many people use on a daily basis. Like if you go on Wall Street Bets, Robinhood is easily one of the most hated companies, yet everybody still posts screenshots of their Robinhood account. On top of that, even though the legalities of payment for order flow have been called into question, it's become so common across the majority of brokerages that I highly doubt it's going anywhere. So when they were trading around $39 a share, I went ahead and dumped $150,000 into the stock, thinking that long-term they'll continue expanding their services. They'll eventually roll out crypto wallets, and maybe one day they get into banking, and then everything will be great, right? Wrong. They were immediately hit with poor earnings and the stock fell, so I went and bought more. And not even a week after that, they announced that they were hacked, so the stock fell even more than that. Going into this, I felt like even though they always make headline news for anything they do, and I don't always agree with their decisions, they've still helped the market by bringing $0 trades mainstream, so that's worth encouraging. But like I said, I made a mistake. Right now, I'm down over 30% and over $80,000, which I'm not gonna lie, stings in all the wrong places.
See, when it comes to Hood, and I know we've debated this stock on Millennial Money before, this industry is highly competitive. The stock brokerage industry is insanely competitive. The crypto exchange or brokerage industry is incredibly competitive, and that's what they compete in, right? And for the long time, Robinhood had the advantage. They were the ones to offer free trades. Well, starting a few years ago, everybody started offering free trades. So all of a sudden this, quote unquote competitive advantage Robinhood had left immediately, right? And almost everybody that has large amounts of money, they use something like Fidelity Investments or TD Ameritrade or others that have been around for a long, long time, that haven't gone through these sorts of issues that Robinhood's always in the news for, right? And so there's a lack of trust with Robinhood. Also, they finessed, right? Essentially, Robinhood, what they did is last year, let's be honest, it was a year where massive folks got into the market, especially in the back half of 2020 and into this earliest year, right? So all of a sudden, Robinhood goes public after showing all these great numbers. Now, Graham should know, like, hey, things as far as the interest in the stock market goes and the interest in finance-related things have gone down over this year, right? So what that's going to be is extremely detrimental to a stock like Robinhood. So that's where you got to start putting these things together. And it's like, Robinhood's numbers are probably going to be, really, really bad for a while here. Never mind if you got some sort of major crypto sell-off for, a 6-month, 12-month, 18-month, 24-month span. That would be the cherry on top. That would be devastating for Robinhood, because essentially Robinhood has been making quite a bit of money from their crypto side, right? Which is going to be insanely competitive and get a lot more competitive. But if we have some sort of major crypto sell-off, like that would just be the cherry on top to toast Robinhood. Robinhood's going to continue to be around, but that doesn't mean it's going to be a great stock, right? So this is some food for thought there.
First, there are a few other options that did not pan out as expected, and thankfully the majority of my stock picks have more than made up for these lessons. Now that the market is trading near its all-time high, with several of my positions being way higher than I ever expected them to be, it's making a lot of sense to start selling and taking some profits, and here's why. Well, the reason I'm selling is because of a term called tax loss harvesting. This is a tax reduction strategy that allows you to sell stocks that have lost you money.
There it is, folks. I've been talking about this for the last, probably 2 weeks on my YouTube channels between here, Financial Education 3, and the main channel, Financial Education. I've been talking about this, tax loss harvesting. This is exactly what's going on in a massive way, and especially with any stocks that are down huge, like Graham's talking about here, some of these stocks, okay? Folks are looking at a lot of these stocks, and if they've sold stocks for gains throughout the year, which a good amount of people do throughout the year, right, for many various reasons, you also have this big tax bill. Then you're also looking at a stock you're down 20% on, 30% on. Some of these were down 40% plus, right? 50%, whatever, right? And you're looking at this and you're like, okay, I could sell this stock. I can now write that off against my gains, and now my tax liability to the government is substantially less. Let's go ahead and do it, right? And then you got the 30-day wash sale rule, essentially, right? So then you wait 30 days or so, go ahead and buy it back after the 30 days is up, and then boom. And so you kind of do this whole situation. And folks like Graham that are, unbelievably successful, right? We would call him the ultra wealthy. They know this, right? The ultra wealthy, they know this, I don't want to call it a loophole, but they know how this game runs, right? And so folks like him go ahead and they do this sort of thing, and funds do this as well. A lot of folks do this. I don't personally employ this strategy, not that I think it's a bad strategy at all. I want to be very, very clear about that. I just don't personally do this because I don't like the mindset it puts me in terms of trying to time out, getting in and out of this stock and then buy back in. It's not my cup of tea, and I do it for psychological reasons, but there's no doubt there's a heavy case to be made that tax loss harvesting can be very, very good, especially if you can get in before that stock starts to skyrocket. Never mind if that stock goes down even more in between the time you sell and you buy back, you're golden, right?
Tax you would owe on the stocks that have made you money. And if that sounds really confusing, here's how it works in a quick example. Let's say you bought 2 stocks on January 1st. One of those stocks is up $10,000 in profit, and the other one lost you $10,000 in value. Well, ordinarily, if you were to sell that first stock for a $10,000 profit, you would have to pay taxes on that profit, which could be anywhere from 10 to 50% depending on your tax bracket. But according to the IRS, you could offset that tax by selling another stock at a loss. And if you structure it correctly, that loss could entirely offset the tax you would have paid on that gain. Yeah. That means that I would be in a very strong position to sell off all of my losing stock market positions by the end of the year, and then I could use that loss to offset the stocks that I sell for a gain. At the very least, I'll be able to raise my tax basis so I won't have to pay as much in the future.
And so this is one of those things that compounds the losses for some of these stocks, right, that are down, that folks were buying December, January, February of this year, maybe even into March, right? This compounds the losses like a massive avalanche where you get selling, breeding, selling, and more folks saying, oh, well, shoot, let me go ahead and take a loss in the stock. Let me go ahead and take a loss. So you get these stock prices pushed down to such ridiculous levels that it's like, how is the stock trading at this particular price? Like, this is absolutely ridiculous. Like, the stock becomes insanely undervalued. And we're looking at, earlier in a video on financial education, the main channel, I did a whole video and we went into a ton of numbers and charts and things like that. And what we saw in that video, we witnessed that essentially stocks are, for the S&P 600 small caps, are trading around the cheapest they've traded at in about a decade, right? Never mind if this continues to go down more and more. And so these small caps just continue to be devastated. They'll probably continue to in the month of December outside of a freak scenario, right? And so it's just an ugly, ugly situation. And the more the stocks go down, the more folks start thinking, let me go ahead and tax loss harvest, right? So it's a avalanche of just downhill movement.
And at the very most, I've made a tax-free profit. Kind of. This is an incredibly common tax strategy that a lot of investors utilize by the end of the year. And in fact, it's so common that it even has a term called the September effect, which typically results in a volatile stock market as ETFs and mutual funds sell off losing positions for better tax efficiency. Not to mention, if you have losing positions that could potentially offset your profits, then it's worth it to structure these in such a way that reduces your taxable gain. In addition to that, if your capital...
The majority of folks end up doing it basically in the back half of November and into December is when a lot of folks do it. And some folks try to jump the gun, which isn't a bad strategy as well. Get out before other folks start to sell out of a lot of these losing positions. That way they can buy it in again at the end of December when some folks are still selling, or at the beginning of January, and they kind of beat everybody. Because meanwhile, you got other folks that are waiting for their 30 days. Because let's say you wait. Let's say you like a stock a lot, right? But you want a tax loss harvest. So you go ahead, you sell the last week of December. Well, now you have to wait till the last week of January to buy that stock back to get over the wash sale rule, essentially. So this is some food for thought there.
Losses exceeds your total profit, meaning you've lost more money than you made. Then congratulations, you're a proud member of Reddit's Wall Street Bets, and that remaining amount can be deducted against your earned income up to $3,000 a year, and any amount above that can be carried forward into future years. So let's just say you bought into Corsair Gaming, and now you have a $6,900 loss. Well, if you have no other investment profits...
I wish my loss was only $6,900 in Corsair. Whew! How about like $690,000? No, I'm just kidding. It's not that big, but it's okay?
Reduce your taxable income by $3,000 in the first year, $3,000 in the second year, and $900 in the third year until your loss is completely deducted 100%. However, there are a few rules when it comes to this and a few very important pitfalls you must avoid if this is to be done correctly. But before we go into that, I want to say a huge thank you to the sponsor of today's video, Wealthfront. For those that are aware,
Graham, come on, man. This is Hungry Bowl. Hungry Bowl. I want to thank today's sponsor of this video, the Hungry Bowl. And let me tell you, the bowl is hungry. Download it now on your iOS and Android store for great fortunes in the future for you. Our daily newsletter, we cover breaking news, trending stories. We make our own trending stories, track your stocks, cryptos, everything like that. And listen to earnings calls right inside the app. You like that? How about reading SEC reports right inside the app? You like that? How about looking at all the in-depth financials right inside the app? How do you like that? And for free, literally for free. It's like the best thing ever. Download the Hungry Bowl, and that's all you really need in life is the Hungry Bowl. And remember, the bowl is hungry. Alrighty, let's get back to this video here and see if there's anything else G-Man's got for us.
And then buy that same stock.
Oh, now he's talking about wash sale rule. Okay.
Yep. The IRS does not allow that. Yep. Loss will first offset that same type of gain. And I know that sounds like it makes absolutely no sense, but it'll start to piece together in a sec.
Oh, it makes sense. I think you guys all understand.
Bad situation or turning lemons into lemonade. If you have a loss at the end of the year, you may as well sell that losing position to offset some profits and then increase your tax basis in the process. If you don't do that, then potentially you're paying more tax than you need to, and you're not taking advantage of a tax code that's designed.
The risk you have is if that stock skyrockets in the short term. And the other risk is that, once again, this is not a talked about risk. The other last risk when it comes to this is if you start thinking like this, right? Why not start doing more of that in the future, not just around tax loss? That you kind of start running this fine line of like, do you also start thinking you're smarter than maybe you are, and you start making more short-term moves, right? And you're like, well, I did this successfully. What maybe in the future I'm going to do something like this, but then all of a sudden you start doing it mid-year or the beginning of the year. And so that's, I think, a big risk. If you can understand that risk and deal with that, then perfectly fine. Also, if you can deal with the fact that that stock could skyrocket when you sell, that's perfectly fine as well. Now, for a lot of these stocks that are beaten down dogs, it's not likely it's going to skyrocket in between the 30 days you sell and you buy back in, right? However, it is a risk, and I've been part of a lot of stocks that I've seen them fly up in a massive way, and I've watched a lot of stocks that I wasn't part of fly up in a massive way in a matter of 2 or 3 weeks. I mean, I've seen, Voyager's a perfect example. Voyager stock went from like $8 to next thing you know was trading at $16 plus in literally like a 2-week span. I don't know if you guys remember this. Was probably maybe 2 months ago now. Stock was trading at 8 something a share. Next thing you know, 2 weeks go by, it was trading at 16 something, right? So that's the one thing you kind of risk in this whole situation. Is also some really good news comes out. All of a sudden you get a short squeeze in a stock, and next thing you know, that stock's also up 50%, 70%, 100% from where you sold out of, and you're there looking like, why did I tax loss harvest again? Now, once again, that's not going to happen with most stocks. But every once in a while, it can happen, and you just got to be willing to accept that, right? You've got to be willing to accept that. And if you can accept that, then great, okay? So, at the end of the day, I think when it comes to, retail investors and folks that are newer to the market, I think, you got to really do your research work in these stocks and make sure you're buying into companies not just because you think it's going to go up, but because you're very, very confident it's going to go up over time. The short term, you can't determine that, and you can't predict if a stock's going to go up short term. That's just not how this works, right? You can try to look at charts and do those sorts of things, and that's obviously not what I get into on my channels. But for the most part, you can't predict if a stock price is going to go up over the next week, the next month, the next 6 months. That's not the way this works, right? But you can basically predict fairly accurately if a stock's going to go up over the next 3, 5, 7 years, right? By doing the research work and understanding that and keeping track of this stuff. Not everybody wants to do that, and so at the end of the day, it's better to buy index funds. And I feel like for somebody like Graham that doesn't really want to put in the research work, I feel like most of the time it's better off just to buy index funds at that point in time. Because you buy an index fund, you don't have to worry about listening to conference calls or investor presentations or the fact that you never did the proper research in a stock and all of a sudden you're down 50% on it and you're like, oh my gosh, I got to sell this stock. So that's just not, a healthy thing, obviously, guys. So anyways, much love as always. I hope Graham enjoyed this video as well. And I don't think you'll see it over here on this little baby channel. But thanks for joining me as always, guys. Much love and have a great day. Don't forget to subscribe.